Okay, good morning, everyone. This morning, Learning Catalytics is exhibiting some instability. We can get in it and then we cannot get in it. So we are not using Learning Catalytics at all today, which means we're not doing any kind of participation credit. There'll be no score for today. I'm still going to embed the questions. The questions are still in today, so we'll still talk about those. We'll go over those. Everything will work the same, but there is no Learning Catalytics today, so we'll go forward from there. Okay, I have a question that says is the final going to be go to the computer lab? It depends what section you're in. Our final exam runs Monday morning, 8 a.m. you have to finish it by noon, I believe, on Friday. And if you're in the online sections, you do ProctorU. If you're in here, you do the computer lab. I'm not going to talk, I just saw that question there, that's why I thought I'd answer it. So not talking about the final yet, but the final's not cumulative. It's over chapters 9 through 13, and it will be due, I think, noon on Friday. I think it's up for everyone. Okay. Okay, so the first question that we don't have in Learning Catalytics is, which of the accounts below is usually not a liability? This is going back to last week. So this is, the questions I have today are not in Learning Catalytics. This is a sit back, do the answer in your mind, pick an answer, and then I'll go over it. So that's how we're going to roll today. Which of the accounts below is usually not a liability? Interest payable, unearned revenue, taxes payable, investment in bonds. You know the answer? I'm going to call on people today. Put you on the spot here. What do you think it is? No one can hear you. That is correct. You are correct. The answer is D, investment in bonds. Investment in bonds is an asset. So interest payable, unearned revenue, and taxes payable are all liabilities. Okay, so last week we did liabilities. Then today and Wednesday, we're talking about stockholders' equity. So we are moving to the end of our balance sheet. So we did all the assets first. We did liabilities last week. We're doing stockholders' equity today and Wednesday. And then on next week, we'll be talking about the income statement. The following week, the statement of cash flows. And then the last week, we're going to talk about ratio analysis. And so we're going to do Chapter 10 today. Again, what's due this week? What's due this week is Chapter 10 homework. So it's a pretty standard week. Okay, so starting with this chapter, so we're going to go over some basic information. We're talking about stockholders' equity. So this first learning objective, we're doing some basic terminology, some basic concepts we need to know. We're talking about, when we talk about stockholders' equity, we're talking about a corporation. And there's certain features of a corporation. When you decide to start a business, you have a choice. Am I going to be a sole proprietor? Am I going to do a partnership? Am I going to do a corporation? And the corporation has certain advantages. A corporation, you can raise a lot more capital because you're basically opening up ownership to everyone. People can buy stock in your corporation, so you can raise a lot more capital. You can issue stock. People give you cash for that. If you're just joining us, we are not using Learning Catalytics today. Okay. Corporations also have continuous life. If you have a sole proprietorship or a partnership and one of the owners dies, that entity is ended and you have to restart with the new ownership. Corporations, owners can die and the entity continues to live on. A corporation, very easy to transfer ownership. You sell your stock to someone else. Also with the corporation, we have limited liabilities of the shareholders. The shareholder's loss, if something goes wrong, a shareholder's loss in a corporation is limited to what they have invested in the corporation. Can't go after personal assets. So these are all reasons we would choose to be a corporation. Okay, we can make it easy to raise capital. Okay, anyone can buy our corporation, buy our stock. Continuous life, it doesn't go out of business, it doesn't get dissolved if someone dies. We can transfer ownership easily, and then finally, limited liability stockholders. There's a couple big disadvantages to having a corporate form of business. The first one is owners and management are separate, and the reason that's a disadvantage is they can have different goals. Owners want the maximum return. Management, they might have their own agenda. They want to maximize their personal return, which may not be the same. The biggie is double taxation. And then third one, government regulation. If you have a corporate form of business, you have to file certain reports. There's a lot more regulation on you because you are a corporation. So double taxation, backing up to that, how that occurs. If I'm a corporation is considered a legal entity. So a corporation pays taxes on its income. A sole proprietor and a partnership do not pay taxes on their income. That income from a sole proprietorship or a partnership flows through to the owner. So if I'm an owner of a sole proprietor, my income goes on my own Schedule C. So I'm taxed, my personal return, I'm taxed on it. But the sole proprietorship doesn't pay tax. If I'm in a partnership, the partnership reports the profits to all the partners, and the partners take those profits and put them on their tax return. Okay, and then they pay personal taxes on it. If you're a corporation, the corporation files a tax return and pays taxes on it. And at first blush, it's like, well, what's the big deal? Everyone, the two, you pay personal and corporation pays its own taxes. The problem is as a shareholder, to get any return, to get some return out of the corporation, one thing the corporation does is pays dividends. When the corporation pays shareholders dividends, so the corporation's paid its own taxes, but then it pays dividends to the owners. The owners have to take those dividends and put them on their personal tax return and pay taxes on them. So they're getting taxed at two levels. They're getting taxed at the corporate level. They file their own tax return because they're a legal entity, and then the owners have to pay taxes on the dividends themselves. So that's the double taxation. Okay, Exhibit 10.2, don't write all this down. I just want to point out the big thing here is who's at the very top of an organization structure. It's the shareholders. The shareholders elect the board of directors. The board of directors picks the CEO and things. So the shareholders are really in control. The problem is there's potentially millions of shareholders, so the shareholders have to elect the board of directors so the board of directors can act in their interest. Okay, now, as a shareholder, so this whole chapter is about shareholders and stockholders and how the corporation does the accounting for that. Stockholders have certain rights. The first right is the right to vote. Shareholders have the right to vote on all matters that become before the shareholders. Sometimes the votes are things like, who's our accountant going to be? We've picked an accountant, we've picked an accounting firm, let's ratify it through a shareholder vote. Other shareholders can bring actions to the board, like say, we want, Apple was just sued. Apple was just sued by one of the major investors because Apple has so much cash, this investor wants Apple to distribute the cash to owners through a big dividend. So that investor is suing, or not suing, but bringing this action before the board for a shareholder vote. So there's lots of things shareholders will vote on. Then we have the next thing, dividends. They have a right, all stockholders have the right to receive their share of the dividend. And when we talk about proportional share, if I own 10% of the stock, I should get 10% of the dividend. Okay, liquidation. If the corporation goes out of business after all the liabilities are paid and all those debts are paid, if there's anything left over, our shareholders all have the right to receive their proportionate share of what's left. And then finally, preemption. Preemption means that we have the right to maintain our proportional share. If I own 10% of the shares of stock and the corporation does another stock offering, I have the right to keep my same percentage. That's preemption. It's got a couple more slides of vocabulary because a lot of this chapter is knowing the vocabulary, knowing what the different terms mean. So next we're going into two main types of stockholders' equity. So there's two big categories of stockholders' equity, and there's paid-in capital and there's retained earnings. So up to this point, we've called it common stock and retained earnings. Common stock is part of paid-in capital. So the general category is called paid-in capital. You don't often see this on a balance sheet where it says, here's my paid-in capital, but that's what all these other accounts are, and the retained earnings. So those are the two main categories. Paid-in capital is also called contributed capital. It's the amount of equity that stockholders have contributed. It includes common stock, any preferred stock, and then additional paid-in capital. We're going to see an account called additional paid-in capital. Additional paid-in capital, that word additional is key because this whole category on this left side is called paid-in capital. So that would be the common stock, that would be the preferred stock. But we're going to see coming up that we put certain dollar amounts in common stock, and anything above that certain dollar amount becomes additional paid-in capital. So I just wanted to point out that paid-in capital is not the same as additional paid-in capital. Paid-in capital is the entire category. Additional paid-in capital, we'll see that coming up. Okay, so paid-in capital is this big category of common stock, preferred stock, additional paid-in capital. And then retained earnings. Retained earnings, we've seen that over and over. It's a running total, cumulative total of all our earnings to date less any dividends we've paid. You want to make a note that retained earnings will be decreased by losses. So it doesn't have it on the slide. It's increased by earnings, it's decreased by losses, and reduced by dividends declared as well. So we have two potential reductions, losses and dividends. It's increased by earnings. To further confuse the issue, knowing that these terms are so close to each other, I said we have additional paid-in capital. That can also be called paid-in capital in excess. So there's a couple different ways to phrase it. So you end up having to read very closely what it's asking for. So additional paid-in capital can also be paid-in capital in excess of whatever it is. And we'll see some of these examples coming up. So just know that when we're looking at the words become pretty important because this whole category is called paid-in capital. You would never have a general ledger account for the whole category called paid-in capital. You're going to have individual accounts within there. The whole category is called paid-in capital. We have common stock, preferred stock, and then we have additional paid-in capital or paid-in capital in excess of whatever. And we'll see some of that coming up. Okay, two classes of stock. There are two potential classes of stock we have. First one's common stock. And again, I'm using the word common stock because that's what it's called. It's called common. It's not, the word common is not used as an adjective here. It's common stock. That's the name of it. Common stock, every single company has common stock. Okay? It is the most basic form of stock. It has the four basic rights that we talked about earlier, the liquidation, the preemption, etc. A common stock is where you're going to make the most money if the company does well. This is where you take the most risk, but you get the most potential return. Anyway. Okay, so common stock is the most basic form of stock. This is where you take all the risk, but this is where the potential return lies. Every company will have common stock. It is not possible for a corporation to not have common stock. Common stock is fundamental. Now, on the other hand, preferred stock. Preferred stock is rare. It actually isn't issued by very many companies. Okay, the advantage to preferred stock by the name makes you think it's special. And how it's special is preferred stock, if you're going to pay a dividend, preferred stock has to be paid first. You also, if you have preferred stock and the corporation goes out of business, you get all your money back before common stock gets anything. So that's where preferred stock is preferred. You get your money first in either dividends or liquidation. Preferred stock, the corporation doesn't determine how much dividend they're going to give you every period. The dividend is fixed. Preferred stock will look like, oh, this is 6% preferred stock. That means it pays 6% of the par value every year. Okay, so preferred stock will be a percentage of par or something like that. It will be a fixed dividend, meaning it does not vary. So if the corporation has a really, really, really great year, preferred stock is just going to get the same amount of dividend. Okay, and that's why we say common shareholders can benefit the most. What's the advantage to common shareholders? Well, you're going to get, the corporation can declare dividends. They can declare big dividends in good years. The per share market price of common stock will go up, up, up if the corporation does really well. Preferred stock pays a fixed dividend, meaning it's never going to pay any differently. It's first in line in liquidation and in dividends. So it almost looks like debt because it's going to say, here's what you pay. There is never an obligation for a corporation to pay a dividend, by the way. Okay? So a corporation, even though we say shareholders earn a fixed dividend under preferred stock, they only have to pay a dividend if the board of directors declares one. Okay? So preferred stock, really rare, but it does crop up, so we have to know about it. Preferred stock, though, it's not as risky as common. It's more risky than debt because you're right before common shareholders in that line of liquidation. But it's a fixed dividend, meaning it's never going to be a big, huge dividend. The market price of preferred stock does not typically fluctuate much unless there's some other characteristic about it, which we'll talk about in a little bit. Okay, now, when we talk about stock, we can have par value stock, we can have no par stock, we can have stated value stock. So what does this all mean? Par value is an arbitrary amount assigned to a share of stock. It is decided at the incorporation level when we do our articles of incorporation, when we have our charter, we pick a par value for the stock. What's the par value mean? It's rather arbitrary. In some states, you cannot pay a dividend that makes your par value, that cuts into par value. So typically what corporations do is they set the par value of their stock very, very low. Sometimes they'll set it $1. I'm pretty sure that Apple's par value is now 0.00001 cents or something like that. It's a very, very minute slice of 1 cent. And they do that because in some states it's illegal to do things below par value, so they just do it so they don't have to worry about that legal limit. So par value doesn't have anything to do with market value. It is simply a legal distinction. So a company can have par value stock, and if they have par value stock, it's stated in their articles of incorporation. When they first start their company, the charter, they determine the par value. Par value has nothing to do with market value. We can also have no par stock. Okay, so par values usually set low to avoid legal issues. And no par stock. Companies can, in certain situations, decide to have no par stock. And what they might do instead is have what's called a stated value. These distinctions don't mean a lot to you. They don't mean a lot to shareholders, but we at least need to be familiar with the terminology so when we see it, it doesn't throw us. There's an accounting distinction between par value and no par stock in certain good situations, and we're not going to get too far deep into that. Okay, that brings us to the end of the vocabulary for now. What we're going to do now for the next several minutes is we're going to talk about the basic accounting for stock. So we're going to go through some sample journal entries. I think these journal entries are really good journal entry samples showing you of how it impacts us when we issue stock. So we're going to go for the basic issuance of stock. So this is the corporation issuing stock. Okay, so we have an example. Let's say Home Depot needs to raise $100 million through the issuance of stock, and common stock has a par value. In this case, they're telling us equal to the issuance price. So we're issuing common stock for the par value. So in this really weird coincidence, the par value is $10, the market value is $10. So in that, this is the simplest situation. So if we're going to issue 10 million shares at par value, we're going to debit cash for the $100 million. I think that is 100 million. Yeah, that's all the zeros. And we're going to credit common stock. And this is basically what we've done so far in this class. When we've had examples, especially in chapters 2 and 3, where companies issued stock, we debited cash, credited common stock, and we just were done with it because we didn't go any further in depth to it. So this is what you do if your par value equals your market value, which is never going to happen. But this is just kind of anchoring us with what we were doing before. We made that assumption before so we wouldn't get too far complicated into this. Okay, so that's the most basic situation. That's what we were doing all semester until now, just because we didn't want to complicate it. We said, okay, we'll issue market price is equal to par value. Never going to happen in real life. Well, I guess it could, but it's very seldom. Next up then, okay, so let's go common stock is above par. So let's say same situation, except now the par value is 5 cents. So we're issuing the common stock for $10. The par value is 5 cents. So what we're going to do in this situation is we are going to debit cash. The cash debit doesn't change. Okay, so this first line, we're going to debit cash. That doesn't change. We're selling 10 million shares for $10 each. So the cash is still the same. Now the next thing that does change is common stock. Common stock will be credited for the par value. So we take those 10 million shares and we multiply it by the par value. And that's what goes into common stock. Common stock will only get the par value. If we have a par value stock, the only thing that ever goes into common stock, the account common stock, is par value. Okay, and that's why that's this legal distinction. Okay, now the next account down, shorthand, it's called paid-in capital. That's technically paid-in capital in excess of par, but it gets really long to write. So paid-in capital in excess of par will be for the difference between par value and market value, the purchase price. So that's going to be the $100 million minus the $500,000. This common stock issued above par, this is the most common situation. We'll issue it for cash. Cash is always the purchase price times the number of shares we got. Then we have to credit common stock for the par, and we're going to credit paid-in capital in excess of par for the difference. That is a legal distinction, and so whenever you see a company's common stock account, that's their par value if they have a par value. Okay, now when we do this, so Home Depot issues these 100 million shares. What we're going to see on the balance sheet, so this next one, what we see, this is the stockholders' equity section of the balance sheet. The first thing you see typically in the stockholders' equity section is this whole line description on common stock, and this is where, I'll bring in an example on Wednesday. But this first part says common stock. The first thing it tells you is it tells you the par value. So in the financial statements, in the balance sheet itself, when it says common stock, it's going to tell you the par value of that common stock. It's going to tell you how many shares were authorized. Now there's three different numbers here potentially. Authorized says, in our charter, how many shares are we authorized to issue? When a company starts, when it files its articles of incorporation, has a starting charter for business, it says, this is the most number of shares we will ever issue. So Home Depot is authorized to issue 10 billion shares. That is authorized. Now, reading further, they have issued 10 million shares. So it'll tell you right there how many shares of stock the company has issued. And then there's a third number potentially, and that's outstanding. Now, in this case, issued and outstanding are the same, and we're going to leave that go for a minute. We'll come back to see why outstanding could be different than issued. So the first thing on our balance sheet then, we're going to see common stock for the par value. And then we're going to have the paid-in capital in excess of par, and that would be the $99,500, $99,500,000, and then total paid-in capital, and then any retained earnings they have, and then their total stockholders' equity. So we're going to list our stock, the paid-in capital part, the common stock, preferred stock, and then we'll have retained earnings. So that's the most common situation. We're going to have a par value, we're going to issue stock, and we will have common stock account, and then we'll have paid-in capital in excess of par account, and we'll have retained earnings. And that's the most fundamental, easiest way to look, easiest situation for a stockholder's equity. Now, in the rest of this chapter, we're going to keep adding to this. We're going to add some more pieces in here that we might see. Okay, now, so this was a common situation where we have a par value. What if a stock doesn't have a par value? We can have no par stock. When you see no par stock, so let's say that Apple issues 939 million shares of no par common stock. So this is totally made up. Apple does have a par value, even though it's minute, but this is a made up example. So if we don't have a par value, then everything just goes into common stock. So this is actually the simplest situation. No, it's built in. I know where it is. Oh, there it is. Okay. Okay, so no par common stock, everything goes into common stock. Okay, and then one more common stock situation, and actually this is pretty frequent that it would happen. Let me go here. Okay, so in the early days of a corporation, and this could happen to you, if you're going to start a business, a lot of times people will start a business, they want to incorporate for legal liability issues or other things, and instead of contributing cash, they will contribute property. So they might say, I'm going to contribute a building. I have this building or I have equipment. I'm going to throw that into the corporation, and that will be my contribution, and I get common stock in return. So here's an example. Let's say Kahn Corporation issued 15,000 shares of its $1 par common stock for equipment of a market value of $4,000 and a building market value of $120,000. Okay, so this person, this shareholder came forward and said, I have equipment and I have a building. I'm going to give the corporation that, and in return the corporation's going to give me stock. Very common. Corporations are often cash tight in the early days, or they need property, so the shareholders will say, here's property, give me stock instead. So when that happens, we want to debit the things that were contributed for their fair market value. So equipment, we're told, had a fair market value of $4,000. The building had a fair market value of $120,000. Okay, so the first two accounts, that's the equipment and the building. Okay, those are fair market value. And then common stock, the 15,000 times the $1, that's the number of shares times the par value. And then paid in capital in excess of par is going to be the difference. It's going to be what we need to balance the journal entry. So that's the fair market values, the 4,000 plus the 120,000, the two fair market values less the par value will be what goes into that paid in capital in excess of par. So that's our plug figure. Okay, so next up we're going to do a couple questions. Again, no learning catalytics today, so these questions are on the slides only. So kind of test your knowledge here. Oh, whoops, I skipped ahead. We have one more slide. It looks the same. The same thing goes. We can, in the first example, this is a different example. The first example, the shareholder came forward and issued equipment and building for the common stock. In this example, and this happens so often, we have an attorney. So you need an attorney usually when you start a corporation, and the attorneys often will contribute their services in return. Since the corporation doesn't have a lot of cash, the corporation will say, I'll give you stock instead. So the attorney takes stock. So in this case, the attorney billed the corporation for $25,000 worth of services. That's the fair market value of the services, and agrees to accept 2,500 shares of $1 par value common stock. The fair market value of the stock, irrelevant here. When you issue common stock for services, you always recognize the fair value of those services. So legal expense is the fair value. So again, that market value is not needed for the stock. So legal expense, this bills the corporation $25,000, okay? That's what goes into legal expense. That's what the corporation is getting, is $25,000 worth of legal expenses. So they get the $25,000 of legal expenses. The credit, common stock is always only credited for par value. If you have par value, that is the only thing that's in the common stock account, and then excess in par is what the plug figure to make this journal entry balance. Okay, so now we have a question coming up. And again, no learning catalytics, so this is one for you to try on your own. Okay. Okay, so let's say we have 100 shares of $1 par value common stock issued at $25 a share. Okay, so the market price is $25 a share. It's $1 par value stock. The paid-in capital in excess of par will what? What are we going to do to paid-in capital in excess of par in this case? Increase $100, increase $2,500, increase $2,400, or stay the same. So even though you're not clicking in, kind of mentally pick an answer. Okay, what we're going to see here is that's going to, the excess of par is always the amount over par value. Our market price is 25. Our par value is $1, so we have 100 shares, so 2,400 that we will be crediting paid-in capital for the 2,500. Okay, one more to try. This is not computational. If stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at what? So we're issuing stock for an asset other. So this is, we're issuing a stock in exchange for a piece of equipment that we need, or a shareholder's given a building to the corporation. So when we issue stock for an asset other than cash, the asset should be recorded on our books at what? On our books at fair market value, at cost, at par value, or zero. Okay, and the answer is fair market value. Okay, so fair market value of the equipment or of the services rendered, not the fair market value of the stock itself. We don't use the fair market value of the stock. It's of what we're getting. Okay, 2 more vocabulary slides, and then we're going to go through some homework. There's a lot of terminology in this chapter. Preferred stock. Same kind of pattern as we just did for common stock. We're not going to go through separate examples. But we might have separate paid-in capital accounts. We'll have paid-in capital in excess of par value for preferred stock. These account titles can get really long. Now, when I said before that preferred stock can look like debt, here's a scenario. The reason they look like debt is because we issue them, the market price typically doesn't fluctuate, and we pay a fixed dividend on them, meaning that the dividend's a percent of par value, and that doesn't change. Even if the corporation has a fabulous year, that dividend will be fixed. But preferred stock can have a conversion feature. It can be called convertible preferred stock, and this is very special preferred stock. If preferred stock is convertible, that means it's issued with this characteristic that allows the shareholder, the preferred shareholder, to trade those preferred shares in for common shares, typically if some event happens. And when I see you quit writing this, I'm going to tell you a little story about a convertible preferred stock and why companies would do this. Okay, the company Crocs. So the Crocs were real popular a few years back. Now they're not so much, and they're kind of like, people are looking at Crocs as kind of a one-trick pony. Crocs has tried to diversify, come up with other styles that aren't their clunky style, but Crocs has been struggling. So last year, Crocs was experiencing kind of a crisis where they didn't have enough cash. So an investor group called Blackstone Group came along and said, we'll rescue you. We'll give you $200 million to increase your cash coffers so that you have the money to go out and try these new strategies to revitalize the company. Now, Blackstone is an investor group, and they wanted to help Crocs, but they're not altruistic. They want to make money, right? That's the only reason Blackstone Group is giving Crocs $200 million. Now, so Blackstone, though, very realistic, knows that Crocs is on that bubble thinking, is Crocs going to survive or not? Because Crocs used to be able to find them everywhere. Even the Crocs, there was a Crocs store at the Cleveland airport, which I always thought was odd that you had a whole store devoted to Crocs at an airport. But the Crocs store now at the airport is gone. Okay, it's been replaced by a Cleveland t-shirt company now. Anyways, so Blackstone Group has this $200 million it wants to invest in Crocs. But it doesn't want to just throw away its money. The investors in Blackstone certainly want to make some money. So people at Blackstone, the investors, think there's got to be something they see in Crocs as having some potential. But they want to protect themselves. So they say, you know, the chances of Crocs going out of business is probably higher than other companies just because Crocs is on this downward trend. But we think there's a chance it'll do better. So what Blackstone did, what Blackstone told Crocs is, okay, take our $200 million, but we want you to issue us preferred stock. And why do they want preferred stock? They want preferred stock because if Crocs goes under, Blackstone Group wants to get their investment back. And Blackstone wants to get a dividend. If anyone gets a dividend, Blackstone wants it first. So that's why Blackstone said, issue preferred stock to us for our $200 million. Now, so if Crocs took the $200 million, and this is just plain ordinary preferred stock, and they started doing great, then Blackstone would basically get this fixed dividend on their preferred stock. But Blackstone took a lot of risk. So Blackstone, when they got the preferred stock from Crocs, they said, we want a convertible feature on it, okay? So Blackstone wants the preferred stock, so if Crocs goes out of business, Blackstone gets money back before any of the Crocs common shareholders would get a dime back. Blackstone's going to get paid its money back. Okay, so that protects its risk-wise. But Blackstone also wants to share in the riches if Crocs suddenly has a wonderful product hit and Crocs is back in vogue now and making money hand over foot. Blackstone wants to participate in that. So Blackstone demanded that the preferred stock have a conversion feature. It's called convertible preferred stock. And now what Blackstone can do, there are terms written into the preferred stock that if the common shares reach a certain benchmark, a certain level, then Blackstone has the right, not the required, but has the right to take its preferred stock and trade it in and get common stock. And the reason Blackstone wants to do that is Crocs, if it does really well, the common stock price goes up, 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 Blackstone can take its preferred shares, get some of the common shares, and presumably those common shares will be worth a lot more than the $200 million that Blackstone invested, and then Blackstone can participate in the rewards as well. So that's this conversion feature. Now, we're not going to get deep into the accounting for that. If you're an accounting major and this is intriguing to you, you will see a lot more about convertible preferred stock in a later class. But that's what the conversion feature is for. It's to entice an investor to invest in the preferred stock, knowing that if certain things happen, the investor can convert it into common stock. But if Crocs doesn't do well, Blackstone Group is never going to exercise that conversion feature. It wants to stay there. So if Crocs goes bankrupt in the future, Blackstone will get any money left after Crocs pays all its debts. So preferred stock still comes under all the other debts, but it comes before common stock in case of liquidation. Okay. Now, I said there were three numbers associated with stock. The first one's authorized, and that's the maximum numbers a company can issue. Seldom does a company issue its maximum. If you start a corporation and you do the charter, you're going to make up some enormous number. This is because to change this number, you have to go back and amend your initial charter. So companies will make this just a huge number, okay? And that's the maximum that a company is authorized to issue. It can never issue more than the number authorized. Okay, next one, issued. This is the number of shares the company has issued to its shareholders. So shareholders have come forward, given cash, given equipment, given services, for whatever reason. These are the number of shares the company has issued. And then our final number here is outstanding. Now, outstanding are the number of shares that are in shareholders' hands. So that's what shareholders actually own right now. And what's the difference between issued and outstanding? The difference between these two numbers is how many shares the company has bought back of its own stock. Companies will go back out in the market and buy their own shares back for various reasons. We'll talk about that in a little bit. But once they buy the shares back, they're no longer outstanding. So these numbers, authorized can be a really huge number, then issued a fairly large number, and then outstanding is something less. Outstanding could be equal to issued, but typically is less than issued. You can't have outstanding greater than issued. So authorized is going to be the largest number, issued, and then outstanding typically lower than issued. You're going to see all three of these numbers on the balance sheet, and we'll see an example of that on Wednesday. Okay, so what we're going to do right now, we're going to do a couple of the homework problems. So the first homework problem we're going to do is short exercise 10-5. Short exercise 10-5, we're looking at the accounting for issuing stock to finance the purchase of assets. Okay, so basically we have two situations. Our first situation is we issue stock and buy the assets in a separate transaction. So situation A, we're issuing the stock, we're getting cash for it, and then we turn around and take the cash and buy the assets we need. So case B is we're issuing the stock in exchange for the assets. So we'll just go through each of these. So case A, issue stock and buy the assets in separate transactions. So Odell issued 17,000 shares of its $25,000 par common stock for cash of $756,000. Okay, so the first thing we need to do in situation A is we need to do the journal entry for issuing that stock. So what we're going to do is the cash is what we're given. So they tell us we're given $756,000 cash. Common stock is credited for the par value. We had 17,000 shares times $25 par value gives us $425,000, and then our final credit is paid in capital in excess of par for $331,000. That's the difference between the cash we got and the par value. Okay, so that entry, very standard. You need to know how to do a journal entry for issuing stock for cash. Okay, the credit to common stock will be for par value, paid in capital in excess will be for anything above par value we got. Yeah, the question is, does that mean Apple's paid in or common stock account will be less than the paid in capital? Yes, absolutely. That's typically what you see because the par values are so low. $1 of par value, typically say 1 cent par value, but in Apple's case, common stock is still pretty big just because of the sheer number of shares they have. Even when they have this fractional cent par value, it still adds up. The point of par value is a legal distinction only. It has no point with market value. It has nothing, no correlation with anything. It's a legal, and it's affected differently in different states, but it has nothing to do with the market value. It's just, it is a legal distinction only, and we only are allowed to put in the par value in the common stock account. Typically, as an investor, you're going to look at the two combined. You're going to look at the common stock plus the paid in capital in excess of par combined. That's how much investors have invested. Okay, so this is to issue stock. Then the second part of this first case A is Odell used the cash to purchase a building for $548,000 and equipment for $208,000. So what we're going to do here, we're going to have the building for debited for $548,000. We're going to debit equipment for $208,000, and then we're going to credit cash for $756,000. So that's case A. Case A, we just had two separate transactions. The first transaction, we issued the stock, got the cash. The second transaction, we purchased the building and the equipment with that same cash. Case B, what we're doing is we're cutting out the cash. We're saying instead of issuing the stock for cash and turning around and buy it, let's just issue stock for the building and equipment. So in case B, before I leave this, I want to show you. So in case B, skipping ahead to what we're going to do here. In case B, what we end up doing is there's no cash involved. We have no cash here. We have no cash here. Those are the same amount. So we have the 756 here. 750. So there's no cash involved. We end up taking this building and equipment that we had here, and it goes up. We do one entry. Okay, so what we have in case B, so case B, what we've got is we have the building and equipment. So we have the building, $548,000, equipment, $208,000, and then common stock and paid-in capital are exactly the same. We do the common stock for par value, and then the paid-in capital in excess of par for the difference. So this homework exercise is saying, are they equivalent? Yes, they are absolutely equivalent. We always value the building equipment at market value when we acquire it. So the two are exactly the same. It's just cash is being cut out of the second example. And then we have one more homework exercise. It goes pretty quick. It's to prepare the stockholders' equity section of the balance sheet. So this is just going line by line. Okay. So exercise 10-6 is the financial statements of Cliffview reported the following accounts. So what we have here is a whole lot of different accounts, and we have to prepare the stockholders' equity section of the balance sheet. And it tells us net income has already been closed to retained earnings. What does that mean? When we did closing entries several chapters ago, it's just telling us we don't need to worry about net income at the moment. So the first thing we need to do, the first thing to do on this is to go through and cross out the accounts that are not stockholders' equity, because stockholders' equity accounts are going to include our common stock, any preferred stock, paid-in capital in excess, retained earnings. That's all going to go in stockholders' equity. So just looking down the list, I want to get rid of the things that are not in there. So paid-in capital would be, other stockholders' equity would be, common stock would be. Long-term debt is not. Okay, long-term debt is a liability, so it's not in the stockholders' equity section. Total revenues, it already told me it was closed into it, so I don't need total revenues. I don't need accounts payable. Retained earnings would be. Other current liabilities is not, and total expenses are not. Okay, so that was the first thing. Just remove everything you don't need to deal with on this statement. So then we have all the other accounts that are given to us, so we can start with what we're doing is we're saying here's what the stockholders' equity section of the balance sheet is going to look like. So first thing listed is always going to be your common stock. Your common stock, when you have that line, you have the par value. This is 1 cent common stock, and it tells us 900,000 shares issued and outstanding. They don't have an authorized on here, so that's fine. So it's 9,000 and those are already given to us. So the very first thing, we're going to issue that, we're going to list that common stock. Next up, we'll put the paid-in capital in excess of par. Okay, next situation we have, next account we have, retained earnings. Okay, now we have one more account here, and if I were writing this homework exercise, I would not have included this because this is just kind of a weird thing. If we were listed other stockholders' equity. Okay, other stockholders' equity, it's a negative amount because they gave it to us, so we just take it, we stick it down at the bottom. Okay, and do I know what that is? I have no idea what it is, but it's in the exercise. And again, if I wrote it, it would not be in there. Okay. So we put it in there, we put it in negative because that's what they told us it was. So then we get to the bottom of this exercise and we're simply going to add up all those items. Okay, one more concept for today. It relates back to the difference between issued and outstanding. I said the difference between number of shares issued and number of shares outstanding is the number of shares the company has bought back of its own stock. That's called treasury stock. Treasury stock is this next learning objective 3. And treasury stock are shares of stock the company has bought back of its own stock. Reasons that a company would buy its own stock back. It might need stock for its employee stock ownership plan. It might think its stock is way undervalued, so it'll go out and buy its own stock back at a low value and then reissue it, sell it at a high value. They might be trying to avoid takeover. They might want to increase their earnings per share. On Wednesday, I'm going to bring in a couple examples of companies doing pretty big stock buybacks and talk about why they might be doing it. So treasury stock is stock that a company is buying back of its own. Treasury stock, the accounting for treasury stock is actually pretty easy. The accounting for treasury stock it's recorded at cost. Par value doesn't affect treasury stock at all. It's classified as a contra stockholders equity account, which means it has an opposite balance of everything else, so yet another contra account. It's contra stockholders equity account. That means it has a debit balance. And let's say we bought back $4 billion worth of stock. So we spent $4 billion buying back our own stock. We're going to debit treasury stock. We're going to credit cash. That's it. Treasury stock is a contra stockholders equity account, meaning it has a debit balance. It reduces stockholders' equity. It is not an asset. We can't own ourselves. So when we buy it back, it's no longer outstanding. So treasury stock is just going to be debited for the cost. Cash is going to be credited for the cost. That's it. So treasury stock, the accounting for it, very, very easy. We don't worry about the par value. It simply goes into treasury stock. And treasury stock is this contra stockholders equity account. Now, I don't want you to write down the whole next slide. It's so long, but I want to show you how treasury stock shows up on an income statement. So on a stockholders equity section of the balance sheet, stock at the very bottom of the balance sheet, typically in the stockholders equity section, we'll see treasury stock listed, and the thing to note about it is negative. It's a contra stockholders equity account, so it's always shown as a negative, and it reduces total stockholders equity. And So if we sell treasury stock, so we buy treasury stock and then we reissue it later, it will increase our assets and our equity if we resell it. We get cash and we remove it from stockholders' equity. There is no gain or loss on selling our own stock. Okay? We're just treating things at cost. We do not have gains and losses on sales of our own stock because that would allow companies to play too many games. Okay, and we are going to end up here today. There was no Learning Catalytics, so there will be no participation score in My Accounting Lab. So I will see you on Wednesday. On Wednesday, we're going to have a lot of real-life examples of this stuff.